All right, so what's the profit equation? Oh my gosh, did I forget my markers? Are you kidding me? I can't live with that. How did I pull that off? Going for that little bit of time. All right, well, let's see. I guess we're gonna do another short video while I get my markers. This is kind of a fun one that we didn't get to do before. All right, so what was an externality? We've talked about that in a couple different chapters, really, and we're going to continue to talk about it. What was an externality? Oh my goodness, this is gone too. Who's got externality? I've never actually met anybody with a louder whistle than me, so, and I'm 50 years old, and I've been whistling like that my whole life. My wife usually hates me for it, especially at sporting events, but. All right, what do you got? Externality. Who's got it? Who's got it? Yeah.
Negative or positive effect on a third party, not directly related to the transaction.
Okay, so an externality is one reason why we might not get ideal solutions in a marketplace, because two people, a buyer and a seller, are doing their thing, right? Totally voluntary. I want to do it, you want to do it, we get together, it's a win-win situation like Tom and Jen on the island. But then as a part of the consumption or the production of the good that's being traded, something negative or positive happens to third parties. And so that's a problem of property rights. And so this is kind of a nice little video that explains some of that.
Not a potato. When it's an externality.
I will be back in just a minute. It's a fairly short video.
An externality is when a transaction between two people, call them Art and Betty, has an effect on a third person, Carl, without Carl's permission. Suppose Art sells Betty some potato chips. Now Betty really likes potato chips. She opens the bag, she's looking forward to eating the chips. As she eats them, she makes yum, yum, yum sounds. Just look at her, she loves it. But no matter how loud she is, there is no externality unless someone, like Carl, is there to hear her. Obviously, Art benefits from selling the product, and Betty benefits from buying the product, since this exchange was voluntary. But Carl's affected by a negative externality. He's harmed. He didn't get anything, but he has to listen to all that crunching, yum-yumming. It's really noisy. So it takes three to have an externality: a seller, a buyer, and at least one additional person who is not voluntarily a participant in the transaction. In a previous video, I claimed that prices can tell people the right thing to do. But if there are externalities, do prices tell us everything we need to know? The answer must be no, because with externalities, the price of something and its actual cost are different. The price is the amount Betty paid to Art, but the cost is the amount Betty paid to Art plus the cost to Carl of having Betty crunch potato chips in his ear during class. The problem with externalities is that prices do not capture all of the costs of the transaction. Instead, some of the costs are borne by people who never gave their permission. It seems like the solution would be to try to adjust price so that it coincides with the total cost. For many people, that means fix it with taxes. In other words, impose a tax equal to the difference between the market price and the true cost. Of course, the buyer and the seller to bear the full cost of their transaction. This is what economists call internalizing the cost. We may not need to resort to government action, of course. One way we solve externality problems is called manners. If Carl tells Betty her crunching is bothering him, she'll probably apologize and stop. And there's bargaining, a solution proposed by R.H. Coase. If Carl complains, Betty might make a side payment, sharing her chips with Carl. Once Carl's crunching too, there are no externalities, only chips. Even if these solutions don't work, it may not be easy to fix it with taxes through state action. Remember, the problem is information. Prices don't contain the full information about cost. But where can accurate information be obtained? How can the state be expected to acquire more accurate information and then act on it effectively? The most interesting answer to these questions came from the original scholar to propose fixing it with taxes, A.C. Pigou. Pigou was a really smart guy and understood that guessing at the correct tax would be very difficult. Back in 1920, Pigou said, "It is not sufficient to contrast the imperfect adjustments of unfettered enterprise with the best adjustment that economists in their studies can imagine. For we cannot expect that any state authority will attain, or even wholeheartedly seek, that ideal. Such authorities are liable alike to ignorance, to sectional pressure, and to personal corruption by private interest, a loud-voiced part of their constituents, if organized for votes, may easily outweigh the whole." The fix-it-with-taxes solution often has unintended bad consequences. The government has a knowledge problem, just like everybody else. Every economics student learns about externalities and Pigovian taxes, but professors rarely mention how hard Pigou himself thought it would be to get those taxes exactly right. Keep learning liberty.
All right, so there's just kind of a quick aside. All the importance of property rights and internalizing problems as best we can, not always easy to do. All right, so what is the profit equation? That was a little bit of unrelated. Oriana, can you move your camera down? So we got your face making up about 25%. All right, profits. We're gonna talk business today. How does that company make a profit? Equation. This is the one I want rolling right off your tongues. Total revenue minus total cost. Good. So total revenue minus total cost. And so this chapter, we're really focusing in on the total cost part of this equation in a couple different ways. So here, for total cost, we're going to break it into costs that are explicit and implicit. And I think we made this distinction before, so we won't spend too much, but I think it's important with what we're talking about in this chapter as it relates to the company and measuring the types of cost. So explicit costs were accounting cost. What I mean by that is that they have an easy price tag. So you get a receipt with it, right? You actually paid real good hard cash with it. And so you turn it over to your accountant, and your accountant can then get your books put together and also turn it over to the IRS to pay taxes or whatever, right? So things with an easy receipt. Whereas implicit costs are not so easy. They don't have a receipt. So it's the thing you could have done if you didn't do what you did, and it is our economic art is what I like to think of it. Why do I call it art? Because you have to do some estimating, and you have to use your head here to think about that. So implied cost, it's things that were foregone, right? The things you didn't do. Now, the foregone part I don't want to put too much emphasis is over here too, but it's easy to see. If I spent $100 on something for my business, that was $100 I could have spent on something else, right? So there's still that foregone aspect. But here, a lot of times with this, it could be, time. How do we measure time? That might be one thing that's involved there. What could you have done? So together, explicit and implicit cost end up measuring what we call opportunity cost. So this is your total cost in economics class. This is your full opportunity cost. You lost something you could have done with that money, and also something you could have done with your time. And so together, that's really your full opportunity cost. All right, any questions or comments there? So let's suppose that there's let's just do a little example here to kind of bring this home hopefully. Suppose we have an English professor at Ottawa University that decides to open up a restaurant. So suppose an English professor decides to open a restaurant. What's the name of her restaurant? What's the name of the restaurant? English professor opens up a new restaurant. Give me a name. Who's got those? I told you this is art, so we want your creative hat on a little bit. What's the name of our English professor's restaurant? You got something?
I was just going to say the gym and the donut shop.
The what?
The gym and
The gym.
yeah, it's the donut shop.
Okay, so you want to call it the gym.
Yeah.
All right, that's fine. Whatever you guys came up with, that's extra credit. Give me your name again. Will, last name? Burns, okay. And it was Evan, right?
Yeah.
Okay. Evan Johnson? Yeah.
Yep.
All right. The gym. And is this GYM? Or is it some fancy spelling?
Sure.
Okay. Open a restaurant called The Gym. Okay. What's our English professor's name? You guys help me create. This is like an interactive example.
Chuck.
What?
Chuck.
Chug?
Chuck.
Chuck. Got it. Who's that, Rich?
Yeah.
What's your last name again, Rich?
Blevins.
Blevins. All right, so Chuck. So English professor Chuck opens up the gym, a restaurant. All right, so here's what goes on with the restaurant. So we've got kind of some costs. So costs of restaurant, of the gym. Let's go the cost of gym here. All right, so let's go rent for the building. Rent for the building. That's going to be 50 grand. And this is per year. And then we've got grills and coolers, dishwashers, equipment, right? All that other sorts of equipment for the restaurant. That's all on kind of a lease deal of $200,000 per year. And then we've got labor, people, cooks, and wait staff, and dishwashers, etc. And that's $110,000 per year. Now the other part of our story is we need a manager, but the ex-professor Chuck, the ex-prof, is the manager. Is the manager, so that he doesn't have to pay the market rate for a manager of $35,000 per year. Now, he was, parentheses, he was making 60K, 60,000 as a prof at OU. Okay, so if the total revenue is equal to $400,000 per year, what are profits? What is the level of profits? So you got enough information here. There's the profit equation. You've got some costs. You got some revenues. Go ahead and calculate what profits are. As soon as you get an answer, shout it out. And Oriana, unless she went to the restroom or something. Oriana, are you there? Is that you with something red on your head? Oriana going once, Oriana going twice. Did she leave? Did you see Tyler? Okay. Caitlin, I said shout it out!
Oh, 340K.
340K. What'd you get? Same? 340K. 40. How much?
40K.
40K, sorry. 40K, and what'd you get? Awesome.
Yeah, I got 340 for the total cost.
Okay. So what was your profit then?
40,000.
40,000. So we got two 40s. Anybody different? Everybody's got 40. All right, so let's go back and see where this 40 came from. So it looks like you took a grand total here. So 50 plus 200 plus 110. So we got 250. We got 360. 360,000. And then we've got the 400. So it looks like you guys did something along the lines of 400. I'm just going to put K here. 400K minus 360K gives us $40,000. Uh-oh. Is that me? Wow, you guys get extra credit today. Why did I even have the... Oh, this was when I was on my trip. That's why. All right, pull out a piece of paper. You can share a half sheet if you want, but I want a separate sheet of paper for each person so that I don't screw it up. But you can cut them in half if you want. First name, last name, Russ Busted. Today's date is the 7th, 2/7. First name, last name, Russ Busted. And you've got 10 seconds. I hate that I wasted your guys' time. I'm very sorry. I apologize profusely, but you've got 6 seconds to get these in. You guys on Zoom, Tyler, go ahead and just Zoom me a Russ Busted for the extra credit. So you got 3 seconds left. 3, 2, 1. Now push them into the aisles. 10 seconds for me to collect everybody's paper. Go, 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 go. All right, 10. 9, 8, 7, 6, 5, 4, 3, 2, 1. Woo, we made it. Okay, there we go. Enough of that business. So, okay, so this seems pretty reasonable, right? If you're the ex-professor, there's your cost. And you made 40 grand. There's no doubt that the ex-professor has that number in mind here. This is Chuck. So the ex-professor says, I made 40 grand. Now, is that really what the business made though? So the accountant might look at this and say, well, wait a second here. If we're thinking about the gym and we're looking at the profitability of the gym, we need to pay you for IRS accounting purposes. We need to pay you $35,000, right? So maybe the accounting or the accountant for the gym comes in and says, "Well, I got the 360, but we also need to pay you 35 so that your restaurant actually made 5,000, right?" So this is maybe the accountant. And the Chuck looks at the accountant across the table and says, "Well, Chuck, last time I checked, I know I'm not a math whiz, I was an English professor, but 35,000 plus 5,000, and I own the business, 35 plus 5 equals 40. So screw you, do all your hocus pocus with my books, I don't really care. I know I made 40, right?" So that's fine. Well, there's one more version here that I was hoping maybe is scratching your back. Does that really capture all of the English professor's opportunities? Does it really capture the opportunity cost for the English professor? What is an opportunity that's still just kind of dangling out there? Time. Time that could be spent doing what? Teaching. Right? So there's an opportunity cost of time that should be maybe factored a little bit differently. And so the principles of micro student comes in and says, well, wait a second, 35's not enough. What really happened here is you've got 400 minus the 360. We all agree upon that. But your full opportunity cost of your time is the 60,000. Which means what's your profits here, English professor Chuck? Negative 20, right? So we got 420, right? 360 plus 60 is 420. So we get negative 20,000. So this is the econ micro student. Chuck's kid, who's studying economics, comes in and says, I'm not sure you got it calculated out right. Because this is what it's really looking like. Okay, so none of these profit calculations are necessarily wrong. However, I think I'm a little biased. I think one's more right than the other ones, but none of them are actually wrong, right? So to some degree, the ex-professor, Chuck, he's got 40 grand. That's what he gets to spend his money on, right? That's how much money he made. The accountant has reasons for doing it this way for IRS purposes. Maybe the business gets taxed at a different rate than what Chuck gets taxed at, and so maybe the law says you have to kind of keep track of it differently. And then finally, the economics student, I think, has a good point here that how is Chuck doing at the restaurant business? Not so hot, right? It's sending a signal, and that's why we calculate full opportunity cost. Opportunity cost is the thing you could have done if you didn't do what you did, is my Dr. Seuss version. It's the thing you could have done if you didn't do what you did. And so here, by thinking about the full economic opportunity cost, we have a signal. And that signal is very distinct here. It says something like this. You suck. You suck. You suck. No, I don't. I'm just a human being. Yes, you suck. You suck. What should I do? What should I do? Go teach. Go teach. Go teach. Exit. 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 Right? So the profit acts like a signal that says, hey, you've got something else you could be doing. That signal doesn't come across as strong here. You could kind of reason it out though, right? Chuck could still say, oh, I only made 40,000 doing this restaurant deal, and I could have made 60, so it's almost like I lost 20, right? So you could reason it out that way, but a lot of times people don't. And stuff can get kind of complicated. Here we've got the numbers kind of simple, but it can start to get kind of complicated if you don't, and there could be other areas that are being overlooked by not thinking about the full opportunity cost. All right, so that's kind of the big thing. So let's see how that plays out. What happens if the restaurant hangs in there? Does Chuck, let me just say it more generally instead of Chuck, do businesses close their doors immediately when they have a loss? What do they tend to do? What do they tend to do when they experience a loss? What do businesses start to do the next year or next month? Like this year, this quarter, they had a loss, and so what's their response next quarter or next month? What are some things that businesses would try to do rather than just say, oh, I'm out of business? Emily? Lower their prices, so it could be a pricing issue. If the demand for their good was fairly elastic, then maybe a little bump in price, from $10 down to just $9 or something, would cause a whole bunch more revenue to come in, right? So possibly their pricing was off, or maybe they could get creative with other sorts of pricing schemes or something. Good. So I say you're absolutely right. Run a sale, do something with pricing is one way that they respond. Justice?
Cut some people?
Yeah, cut some people, right? So they start thinking, oh my gosh, no wonder we lost money. That person's not working half the day, they're on their phone. Or maybe I should change policy, no phones. Phones have to be put in your locker. Like maybe my workforce wasn't being as productive. Maybe I just need to fire some people, right? So they start changing their cost of production around. Good. Jay?
Could it be the area that they're in?
Okay.
Because the demographic, it could just be that the area could have changed over time.
And maybe they have a business that they can explore other areas, right?
Correct.
So maybe they were in this neighborhood that's mostly gray-haired people, right? So their neighborhood was here, but their business is such that, there's no reason, there's a college right down the road. Maybe some of the younger people, if we started marketing to them, we could get not only the gray hairs, but also some university students, some young blood, right? So we could explore other areas or something. Okay, good. Jensen?
Find cheaper deals when they purchase.
Okay, good. Maybe we were a little sloppy on acquiring the cost of doing business in terms of the resources that I needed. Maybe there's some alternatives that I can do. All right, so that's the point, right? Businesses don't go under, they'll absorb a loss. But can they do that forever? So now, next quarter, it's another loss. And they're like, let's cut a few more people. Let's raise our prices. Let's lower our prices. And then another loss, and then another loss, and then another loss, right? So eventually, that profit signal says, go do your other thing. Go do your other thing. All right, so let's say for Chuck then. Let's say for Chuck, he hangs in there, and next year, sure enough, total revenues go up to 420. What is economic profit? So this one is the one we're focusing in on, this equation. So this is economic profit, is what our Economics 101 student was putting together. This one, by the way, was accountant or accounting profit. So, what is it at 420? The new calculation of economic profit. Yep, broke even. So, big fat zero, right? So, let's just kind of write that out. Profit equals 420K minus the 360K minus the 60K equals 0. 0K. Maybe I don't need the K on there. That might even be confusing. That looks like it's okay. Actually, that's kind of funny though. That is kind of the moral of the story. What signal is this sending to Chuck now? It's a new signal.
He's doing all right.
You're doing okay, right? Is he better off like closing his doors and going and doing something else? No. No, you don't have any other opportunities that would be better than what you're doing now. So, would Chuck like to make more money? Yes, that doesn't disappear, right? So this is like just an outcome of running the business. It turns out that I have 0 economic profit, which means he's really earning, in Chuck's mind, 60, right? To have this equation go to 0, it really means, in Chuck's method here, he's earning 60. He can't do better elsewhere. So the main message here with this signal is that that's okay. So economic profit, sorry, I was trying to avoid using this. I'm not sure I can, so I better just define it here. So I'll use the pi symbol for profit. Like I said, I was almost going to try to break myself of it. I might go back and forth. So let's just say economic profit. We end up writing it in so many places, it's nice to have a shorthand for it. So economic profit equal to 0 is okay. Why? Because you can't do better elsewhere. You can't do better elsewhere. You're doing okay. You'd like to make more. but you can't. All right, so now, what if Chuck hangs in there another year? What happens if total revenues climb to $460,000? $460,000. What does that equation come out to be now?
He's earning 20K.
He's earning 20K? 40K, right? So, maybe you said 40, maybe I misheard you, but so we substitute the 460 in here, and we get profit, economic profit, equals the 460 minus the 360 minus the 60 gives us 40,000 bucks. Now what's signaling? Doing all right? Even better? Even a lot better? Right? $40,000 of profit above his opportunity cost. That's like gravy, right? That's like really good money. Like, oh my gosh, that's a lot of dough. I used to make $60,000 as a professor, and now I'm at $100,000 essentially in my hand in terms of the English professor's way of thinking of it. So 40's that signal. Jay?
So what would the profit have to be total for let's say Chuck wanted to give out a bonus that year? What would that?
Well, that's going to be totally up to Chuck. Yeah, that's just an individual decision. As a profit maximizer, though, you'd want to give out bonuses such that you think it's good enough to retain your good employees, right? And that would be the purpose of it, to reward them for their good work and hopefully keep them around longer. So that's kind of the idea of the framework we put in with profit maximization, that whatever that level is, Chuck may choose to do that, he might not choose to do that. Of course, the one who, if he kind of wants to hoard and keep all the profits to himself, then his employees might leave if there's other opportunities for them, right? So it's always kind of that market process. He's not under any obligation to do that, but a lot of companies find it like a good idea for employee morale and other things to share in some of that. So now I want to go back to the signal though. So yes, he's doing great, knocking it out of the park. He's in the paper, English professor, opens a restaurant and is banging it out. People lines out the door, blah, 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 blah. What's going to happen in the market in little old Ottawa after the word's out that the English professor is knocking it out of the park, opening up a restaurant? What might happen in the general market for restaurants in little old Ottawa, Kansas? Emily?
Change everything to do better.
Okay. So what do you mean change? Like Chuck will change things, or what'll change? So give me a little bit more specific. What's going to happen?
The other restaurants will change.
Okay, good. So so the other restaurants might start to do something different, and then Justice?
More teachers will probably try and invest.
Okay, so yeah, we might see some other teachers, especially maybe the business teachers, right? The business teachers are like, what? The English professor opened up the restaurants, knocking it out of the park? Imagine what I could do, right? And so not only do we have the existing businesses maybe expanding or changing or whatever, but then we also have this opportunity for other people to enter. So what I want you guys to think about, when the profits are going and it's economic profit above the opportunity cost, it's signaling enter, 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 enter. Great restaurant business in Ottawa, Kansas. Lots of money being made. Do other investors want to make money? Yes. So that's going to attract them away from something else they're doing and open up a restaurant in Ottawa, Kansas, or the existing ones expanding what they're doing. So the profits here play an important role in signaling. The you suck signal came out here, and I was using, in the long run anyway, it would be exit, exit. So this would be the exit sign. And let me just put in the long run. And we'll get into the long run, short run distinction here in a little bit. And here, the sign is a green light, enter, enter. Enter is the signal. Okay, so that's kind of the process of how economic profits play in the marketplace in general. When existing businesses aren't making money, then nobody's going to enter the market, right? Unless they think there's some other weird opportunity. But in general, that, I don't want to be in that part of town, as Jay was saying, because of whatever demographic factors. That's not a good place to open up a restaurant. Do restaurants, especially the big ones, the corporations, do they spend a lot of research dollars in deciding on where they're going to open up a restaurant? Yeah, right? So they look at those factors, how much disposable income people have to be going out to eat and that sort of thing. If you're a local, you don't maybe need to do that research as much. You got kind of your gut feeling. You might not be able to put it all together, but you just know from being in the community for 10 years that, hey, I think a restaurant's going to work here, right? I think we could use chicken wings. I saw, has anybody been into the new, what is it, Grub and Chug or something? Little bar, restaurant place on, that place just opened up. I hope that place isn't cursed. I hope they can do well. That's rotated through a number of places, so maybe the Grub and Chug will do the trick. But so, there's always risk. Even if companies do research. Have you ever seen a corporation close their doors? Even though they did a bunch of research? The big restaurants, Cheesecake Factory, Granite City comes to mind. I just saw that one was closed, right? So there's still risk. Even though you do the research doesn't mean for sure you're going to hit it out of the park. Okay, so key point here with all of this profit stuff. So the key point. We calculate economic profit because we want them to be signals to the owner and other entrepreneurs. All right, so economic profit number one, an economic profit less than zero, which was our first case with Chuck, means exit. That's the signal. And again, in the short run, it might mean do some adjustments or whatever, but if that signal sticks around for a while, it means exit. Economic profit equal to zero just signals it's okay. And then I'm going to add on here a little bit extra that this is a long run equilibrium that we'll explore more so in the next chapter coming up. So I'm kind of foreshadowing something that we'll do here in a little bit. So long run equilibrium. So let me just kind of to nurse that out a little bit more. If new businesses enter Ottawa because Chuck's knocking it out of the park, what happens to prices of restaurants? Do they go up or down? Would they tend to go up or down? Down, right? So competitive forces are going to cause prices to fall. How far are they going to fall? Well, Chuck's not going to enjoy this for long. Take it while you got it now. Hopefully you can keep it around as you be competitive and you keep offering that. But in order to be competitive, we'd expect that it's going to get back to zero because prices are going to fall and then your profits are going to erode away. They're not going to go all the way to, Zippo or back to negative here, but back to being okay, right? So we expect okay profits in the long run. And then finally, economic profit greater than zero is really signaling enter. Of course, it means it's doing great for Chuck, but it's the enter sign that's going on. So now we start to think about the market and all the things that are going on with the businesses a little bit differently when we start thinking of profits this way, and that's why economists calculate it like that. Okay, any questions or comments there? Let's see, the one thing I guess I forgot to add that is another way to characterize this that hopefully makes sense. When they're okay, we say that the firm is earning a normal profit. So note, OK implies firm earns a normal profit. So normal profit's kind of the new, a different way of thinking about the OK part. When economic profits are zero, the firm is earning a normal profit. What you'd expect in that type of business, right? Just covering all your opportunity costs, you're doing fine, but it's a normal profit. Okay, so let's further this a little bit more. Old Chuck needs a new grill. Needs a new grill, and a new grill is 10,000 bucks. Not cheap. But because of the increase in business, Chuck's running out of space with the grill. So example number 2. The gym needs a new grill. Which has a price of $10,000. Oops, not a K. I don't want to make it that many zeros. $10,000. Now, the leasing company has an offer. So the lease company has a no money down deal. No money down offer. And what it is 0 today, and then 1 year from now, it's $1,000 more. So you pay $11,000 1 year from now. So no money down, pay $11,000 in 1 year. And then you own, so it's kind of a lease to own, $11,000 in 1 year. And so now the question before Chuck is, do we pay cash or do the financing? That's what lease deals really are, by the way, right? Is a financing deal. What is the effective interest rate here? What is the effective interest rate with a lease deal? So we got $10,000 today if you buy it today, but the lease deal is 0 today, $11,000 1 year from now. What's the effective interest rate that Chuck would be paying if he took the lease deal? How much? $1,000 is the amount of extra payment. And so how would we express that as kind of the percentage rate that he's effectively paying? You're right, Justice. It's $1,000. How much? 10%, right? So 10% of 10,000 is 1,000. So we can kind of imply what the interest rate is, because that's what financing or leasing deals ultimately are, is a financing program. So for financing, which is the lease, you basically have a total cost of $11,000. We got 10% times the 10,000 equals the 1,000 plus the original cost gives you $11,000. So we can kind of think of it that way in terms of a percentage term, is effectively what the leasing company does. So back to my question, pay cash or do the financing thing? What would be better to do? Pay cash or do the financing deal? Pay cash today or $11,000 tomorrow? By the way, Chuck's not cash strapped. Chuck's got like $45,000 sitting in his checking account. So it's not like he doesn't have the funds to pay cash. So So he's got 45,000, just picking out a number. He's comfortable. He could cut a check for it today. So should he pay cash or does he do the financing deal? How many people say pay cash? Show of hands. So good show of hands. How many people say do the financing? The lease deal. So Colton, are you the lone soldier? I didn't really look online. Colton, what are you thinking with financing?
You can see how well works or new grill works if you finance it.
Okay, so you're thinking more about see how the grill works, and then you could, like, if it's a rent-to-own thing, like turn it back to them or something, or?
Yeah, probably something like that. Like it would be if you make more profit than what you finance it for.
Okay, now you're talking my language that I was hoping we were going to get to. So, the correct college answer here is it depends, right? The famous college student answer. So should we pay cash or should we do financing? The answer to this question here is it depends. And I think Colton's thinking about it right. So some of you are saying cash. Most of you are saying cash, I should say. So if you got the cash pay. By the way, if you take my personal finance class, I'm all about the cash thing and avoiding financing for personal consumption. So I do the Dave Ramsey curriculum is what we do for personal finance. So some of you, I think, are going to be in that class spring 2. So if you're not, I encourage it, but it's offered both fall and spring every term. So definitely get in there. And in there, my personal financing stuff is don't do financing. So I feel a little differently for businesses though. What does it depend on? So Colton, I don't know, now that I've given you hopefully some support for your answer, do you want to talk about these profits a little bit more, the way you were kind of going down the right path, it sounded like. So we effectively have a 10% cost of interest, right? If we did the financing deal. So can you elaborate a little bit more?
I would assume it make 10% more in the business.
Okay, so if I can invest the $10,000 and earn 30%, just to pick out a big number, right? So remember, Chuck's business is growing. Maybe he can add like an arcade or something, right? And so that's going to cost $10,000 to add a little gaming area, but he thinks it's going to attract families. You know, we talked about the demographics of maybe all the gray hairs, but one way to get more families in is if I put in an arcade of some sort, right? And so that's $10,000, and if he does the calculations, and if these people come in, he expects a 30% rate of return on doing the arcade. So would that be a good deal? Well, yeah, right? If he takes the $10,000 and basically uses this as a borrowing thing, and he gains 30%, and it costs him 10%, so he gains $3,000 at a cost of $1,000, he's up 2, right? Is he a profit maximizer? That answer is always yes in this class. So he's looking to maximize profits, and maybe in tune with that, he helps families having fun at the arcade or something too. All right, so that is the decision here of building in what's your opportunity cost. If on the other hand, let me write that one out first, and then I'll expand into the other case. So answer, it depends. I'll start it up here. Depends. Number 1, if your opportunity cost is 30% for the $10,000, then do the financing. So we need to think about what else could I do with that $10,000 if I didn't buy the grill today. So how does that work? Well, I'm going to do the 10,000 times the 30%. That's going to get me $3,000. And then I'm going to pay off the $1,000 of the grill expense. Means I am up $2,000. Another kind of way to interpret that is that if I didn't do that, it's like I cost, the true cost of the grill was $12,000 rather than $10,000. It's another way to kind of think about it. That was a pretty expensive grill because I could have done the arcade and I didn't do the arcade, so I gave up on making an extra two, right? So here we're going to try to think about including those opportunity costs. So if, number two, if your opportunity cost is less than 10%, pay cash. For example, suppose opportunity cost is 2%. He's just got it in a lousy checking account, right? And he doesn't have any other plans for it. Well, it'd be pretty dumb to do the financing now. Why? Because if he didn't do it like we're doing here, he's going to get the $10,000 and keep it at the low opportunity cost of 2%. So what do we got here? So 10% was 1,000, so a lousy 2% is freaking $200, right? That stinks. So that's $200 minus the $1,000 for the financing means he's $800 negative if he didn't pay cash. So with this one, do the financing when your opportunity cost was greater than 10%. So opportunity cost greater than 10%, like 30% is the example we did here. Do the financing. Here, pay cash because it's less than 10%. So your answer depends on your opportunity cost, which is what all the economic calculations generally fall back to. What else could you be doing if you weren't doing what you did, right? What else could you be doing if you didn't do what you did? Depends on opportunity cost. Okay, questions or comments there? All right, so with everything we do, so from here on out, when I talk about total cost, or if I put up the equation, total revenue minus total cost, so note, from now on, from now on, when I talk about total cost, assume it includes full opportunity cost, both implicit and explicit costs. Because now I'm going to just start writing the equation, total revenue minus total cost, and I want you guys to know that that is, it's always economic profit. I might not always put economic profit. I might just kind of do a profit equation like this. But since we're in economics class, that means this has got the full enchilada, right? This has got all of the implicit and explicit costs in it from here on out, now that we know this distinction. Okay. Questions or comments there? All right, so our English professor ended up doing pretty good. All right, so I want to shift gears and think about running a grocery store. The reason I picked a grocery store is we've all gone to grocery stores, even whatever part of the globe you're at, grocery store business is kind of a normal known thing. And so what I'd like to do is brainstorm the types of cost a grocery store has. So types of costs for a grocery store. Types of costs for a grocery store. And I'd like to get a list of about 30 things. So I want you guys to do kind of a thought experiment. I'm going to come through you guys on Zoom too to have you unmute here in a sec. But I'm going to just start you guys brainstorming. So imagine you're in Price Chopper or whatever hometown grocery store you want to think about, and that grocery store is trying to maximize profit. And so what are the types of costs that a grocery store face? Go. Resources. More specific, please. Meat. Okay. So meat and product. I'm just going to throw on, you picked meat. You must be a meat lover, I'm guessing, Jensen. That's the first thing that comes to mind in the grocery store. So meat and product costs. Basically, he picks out meat, but out of the grocery store, how many different products are on the shelves? 1,000, 12,000, 10,000, 20,000, a million? I don't know. It's a lot, right? So meat and product costs. Yes, that's what we're looking at. Keep going.
Labor,
Labor, like what? Who are you looking at in your store?
like cashiers,
Cashier, okay? What other sorts of labor?
managers,
Manager, good. And maybe we have a stock person, right? Okay, what else? Little louder?
bills,
The bills like what?
electricity.
Okay, good, yeah. So, I don't need to number all these, by the way. So electricity and other utilities. Okay, what else goes into that cost of doing business? What?
Total loss,
Total loss from what?
either,
Because that'd be more of the profit.
well, it's either more of just saying like, well, no, I was thinking about profit, but I'm also thinking about cost like, in case like somebody were to, what's the word? Take from the store instead of.
Okay, so loss from theft.
Yeah, loss of theft.
All right.
Or damaged goods.
Or damage, yeah. Somebody bumps into the stand, right? So loss from theft, loss from damaged goods. Maybe the customer bumps over and breaks down all the glass jars of pickles or something. Okay, what else?
Food going bad.
Food going bad, good. Spoiled food. You guys are getting creative here. Spoiled food.
Food court.
Food court. Okay, so we got maybe some tables and chairs in the food court. What else is in that grocery store? You guys are walking through the store. What else do you see that like, oh yeah, I never thought about that, but that would be a cost of doing business, wouldn't it?
Samples.
Samples, okay. And I'm sorry, I cut you off at the back, whoever was talking. Yeah, okay, good. The displays. My brother used to do like this is the meat department or whatever, right? So those signs, he was a graphic designer, so he did like the meat department. We got the shelving.
Carts.
What's that?
Cart.
Carts, yeah, absolutely.
Cart.
Got those little shopping carts. Now we're out in the parking lot. You can start thinking about cost of doing business related to parking.
Advertising.
Okay, advertising, good.
Don't they have to
Shipping.
buy like the lot they're in too?
The what?
Like the lot that they're in? Like
Yeah, of course. So rent for building and land. Is that what you meant by lot?
Yeah.
Yeah, building and land. So they're either renting it or they purchased it or something. They got to pay taxes, right? So they have rent, and then a lot of times that's rent to the owner, but there's also taxes.
Shipping of the product.
Shipping, good. Security, good. Now we're cooking here. Shipping, security. What else?
If they have other
Pharmacy.
things in there, like a Starbucks or a.
Okay. So other, let's say Starbucks in store, like then there's banks sometimes and other things. There might be traffic or something related to that. And then I heard a pharmacy, which is kind of be related to this. They might own the pharmacy, maybe they don't. Maybe it's like Starbucks and it's a different owner or something, but there might be some costs associated with that. Okay, coolers, freezers, got all those. How about that person who slipped and fell? Didn't we talk about slip and fall? I thought we did.
Nope.
What else type of fees? We got advertising fees, but somebody slips and falls and sues us, we might need a attorney, like a lawyer, right? So we got legal fees. Insurance, good. That's the other one I was looking for.
Weather insurance, I guess, if you want, or that's still not there, that's.
This could be under that one. All right, this is probably a pretty good list. Pretty good list. Again, I think we could squeeze this thing out like you got the cash register, right? That has a cost. So we got cash register tape, for that matter. If we got really nitty gritty, right? The little piece of paper, would you like a receipt, sir? And so they have to pay for that little piece of paper each time we rip it off. All right, so that's a pretty good list of stuff. And the reason I like to do that is now the next thing we're going to do is make an important distinction of costs that's a little different than the implicit-explicit one. And we want to look at costs that are variable versus those that are fixed. So when Nate went over that with you guys last time, I think you got some good definitions from kind of just defining terms. So today we're trying to put that in action. And so total cost of production can be broken down into two parts. Total variable cost plus total fixed cost. So I'm going to write out the acronym first, but then I'm just going to write it down. So my total cost can be broken down into total variable cost plus total fixed cost. All right, so now, what makes it variable and what makes it fixed? Well, the reason I like to use the grocery store example is that if we think about how they make money on beeps. What do I mean by beeps? Beep, 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 beep. What's happening each time that beep's going? Money's going up. Revenue is going up, right? So cash register money, sales volume is going up with each beep. Beep, beep, beep. Right? So now, what I want to challenge you on is what are the costs that vary according with the number of beeps and those costs that are fixed. In other words, they're independent of the number of beeps. So let's define that and then we'll go back to our list and kind of work through that. So total variable cost, these are costs that vary with quantity. Costs that vary with quantity. Number of beeps at the store. And total fixed costs are costs that do not vary with quantity. So either they vary or they don't. So now let's look at these costs here. What are some of the things that vary? And what are some of the things that are fixed? So let's start with the things that are fixed. I think that's a little easier, not that we have to make it easier, but let's think about fixed cost and variable cost. So I got two markers, try to color code a little bit here. So fixed costs, which are costs that don't change. It doesn't matter if you do 500 beeps or 5,000 beeps, that cost remains fixed over the time period. All right, electricity. So you pick the tough one at first. So basic electricity during the workday, right, is going to be on. So the lights in the store are going to be on. So that would be fixed. Now, can you tell me any story about how electricity could be a little bit variable? So I want to think about the store being on, whether there's 500 beeps or 5,000 beeps. Give me an example of how electricity could possibly spike up a little bit, depending on if you're doing 500 beeps or 5,000 beeps. And you might have to have HVAC experience. Did I have it? Was this class that somebody did HVAC when we went through the things that you did? Must not have been. I thought somebody had heating and cooling experience. Maybe you have a mom or dad or friend of the family that does heating and cooling. If you're doing a high volume of business, when the grocery store is packed, how could you possibly be spending a little more electricity? Jensen?
AC
What's that? The AC running, right? So you got a lot of body heat. How about opening and closing the freezer doors? Does that cause those freezers to kick on more often, right? You open it up, you're letting 70-degree heat into your 30-degree freezer. That condensing unit's going to have to kick on. So it's not going to be huge, but you could possibly say that some of the electricity could be variable. And so, who gave me this one? Was this you, Justice? Who said electricity? Oh, David? Okay, so you picked a tough one right out of the gate, but it's a good one to bring up because some might vary, some might not, right? So you kind of think about the electricity, probably the overhead lights would be fixed, but we might think about the coolers being used more frequently during the busy time as a little bit variable. I would say you're right. If I had to pick electricity for the business, in general, is it more fixed or more variable? I'd say it's more fixed. I think you're right. That most of the utility bill is probably pretty stable through the course of the month, so it's mostly fixed, but there could be an element of that. All right, so let's try to pick an easier one. Maybe none of them are that easy. I don't know. We'll see. Caitlin. Rent. Absolutely. That's probably one of the best ones. All right, so your landlord is expecting $3,000 a month. They don't care if you do 500 beeps or 5,000 beeps, right? Your rent is going to be what it's going to be. So your rent is fixed at $3,000 per month. And that means it's definitely a fixed cost, right? So it's going to fall on this side of this equation being fixed. All right, what else is fixed up there maybe? Mason?
Shelving.
Shelving, yeah. So that was kind of long gone. Whether the shelves are empty or whether they're jam-packed, the cost of the shelving was fixed.
Tables and chairs.
Tables and chairs, good. So here we go, tables and chairs. Now, if we're having a real busy day, the labor to clean the tables and chairs and reset them all of a sudden would be probably pretty variable, right? So, but the tables and chairs themselves would be fixed. Rich? Security, yeah. So probably, we might be able to tell a story of needing to change the number of security guards or something, but yeah, it's going to be mostly fixed, right? We have most grocery stores, at least in areas that there's not a ton of crime, you're going to have one security guard maybe or something. And then also, I guess I wasn't even thinking about recording devices and all of that stuff. That's all fixed for sure, right? So most of security would fall into the fixed category. Okay, good. Any other fixed ones up here? Yeah, Mason? Cars, yeah. What else? There's more. Taxes. So taxes can have a couple different elements. So sales tax would be variable. More beeps. Each time there's a beep, there would be a new 10% sales tax that's due, right? But property tax, which is what I was kind of referring to, I think Justice read my mind here. Property tax is based off the actual building itself, and it doesn't matter if you do 500 beeps or 5,000 beeps. So property tax would be fixed, sales tax would be more variable. All right, insurance. Do we got to pay more or less insurance depending on how business was this week? No, it's fixed. Legal fees. If we have an attorney on call or something, maybe if there's higher volume of business and we're getting sued more frequently, but for the most part, legal fees are probably fixed. You got to pay some sort of legal fees to do things. Coolers and freezers. All right, so a lot of this stuff, this is probably a rental arrangement. The displays, maybe it's a temporary display or something. All right, so how about the labor bill? Cashier, manager, stock person. Which one of these is fixed? Manager, right? So during store hours, you probably got a fixed salary of a manager. If business is slow, then the manager says, oh, we have 10 cashiers on, you're cut. How many of you have been told to punch out? Like, we're going to have your shift shortened today because we're just not busy enough, right? So some places may or may not do that more than others, but the cashier, we're going to staff differently depending on if we think it's a busy time or not, right? So those, we have some possibilities of being fixed and variable depending on the type of labor it is. And then we got to go back to Jensen up here. Fixed or variable with all of the products that are being beat. Variable, right? So that's the big variable cost. So make sure we circle this one. Each beep means now I can book that cost for the product. All right, so that's our breakdown of total variable cost and total fixed cost. Why is this so important? Well, what do we talk about in economics? What is economics really about? Making a freaking good decision. What should I do today at Price Chopper? What should we do this week? When I think about what we should do today as a manager at Price Chopper or at wherever you work, should I be taking into account the rent that I pay? Today, does that matter today? For today's operations, does that matter? No. So that is where we'll kind of go with this, is that the only costs that matter for decisions today is the things you can control, and that's the variable costs. All right, adios, we'll see you tomorrow.
Was the stuff we were doing earlier, was that including taxes and stuff?
What stuff?
When we were talking about like the 40,000, the 40.
Yeah, I mean, we just had, those were the numbers we were working with. So yeah, we could have made it a long list of stuff, but just to keep it simple.
Do you have the hidden sheet?
Yeah, except I want to get the Zoom people here next.
Okay.
So, let's see. I had a pen somewhere. Can I have your pen? Thank you. Let's see. Okay, so Tyler, gotcha. I forgot to go back to you guys for comment on this. Oops. And Oriana, I wanted to chat with you, Oriana, if you're still there.
Thursday. I don't know what we're doing Friday.
And Noah, gotcha.
I don't remember
Okay. Oh, you just want to sign too. Okay. So Oriana, if you could. Okay, yeah, if you could stay on.